So, what makes a totally rational person trade their entire life savings for a single flower bulb, or pour money into a company whose business plan is literally a secret? Well, it's something called the madness of crowds, a wild pattern that just keeps repeating itself all through financial history. Today, using the classic book A Random Walk Down Wall Street as our guide, we're going to dive into the wild psychology behind these speculative bubbles.
And to kick things off, here's a little dose of humility from, of all people, Sir Isaac Newton. I mean, this is the mind that basically figured out gravity and how the planets move, yet even he was completely powerless against the market. After getting his wallet absolutely cleaned out in a bubble, he said this, and it just perfectly captures that illogical, deeply human force that drives these manias, a force that even a genius can't predict.
All right, our first stop takes us back to 17th century Holland. And we're going to talk about a story that honestly sounds like a fable, but I promise you, it is absolutely true. It's the story of how an entire nation completely lost its mind over a flower. Yep, we're talking about the tulip bulb craze. Okay, just look at the timeline here, and you'll see how fast this all went down. For decades, tulips were, just a luxury item for rich people. But then, between 1634 and 1637, something just snaps. The market goes completely vertical. Get this. In a single month, January 1637, prices exploded by 20 times. And then, just as quickly, poof, the whole thing collapsed.
And to put this in perspective, at the absolute peak of this madness, a single rare tulip bulb was being traded for actual mansions, for huge plots of land, or for enough money to last a lifetime. People were literally trading their homes for a flower bulb. The price had become completely, totally disconnected from the thing itself.
And if you want a story that shows just how absurd things got, listen to this. There was a sailor who grabbed what he thought was an onion to have with his lunch, and he accidentally ate a fortune. He was thrown in jail for months for eating a bulb so valuable it could have fed his entire crew for a whole year. When eating an onion becomes a felony, you know for sure you are in a bubble.
So you might be thinking, okay, that tulip thing was a bizarre one-time fluke, right? But it wasn't. This pattern repeats itself over and over with remarkable consistency, just with different things. The story is always the same, it's only the century that changes.
So check this out. Almost 100 years after the tulips, investors in London were throwing money at a company whose business plan was literally a secret. The advertisement basically promised huge profits for an undertaking that nobody to know what it is, and people lined up to invest. Now fast forward almost 300 years to the dot-com bubble, and you see the exact same thing. Investors pouring billions into companies with terrible business models, like Pets.com, which it turns out lost a ton of money shipping heavy bags of dog food to people's houses.
And the list just goes on and on. In the Roaring '20s, everyone believed the party would never end, right up until the great crash of '29. Then in the '60s, you could literally take any old company, just add the word electronics to its name, and watch its stock go to the moon. In the '80s, investors were scrambling to buy shares in brand new companies that had never actually made any money. Each era has its own little flavor, but the underlying story, it's identical.
So these stories aren't just about bad investments, right? They're really about these predictable patterns in human behavior. And that leads us to the real question here. Why does this keep happening? What is it about us that creates this madness of crowds?
I mean, really, why do we, as seemingly rational individuals, get pulled into these collective delusions? Well, it turns out the answer has less to do with financial statements and way more to do with how our brains are wired.
The economist John Maynard Keynes had this brilliant analogy for it. He compared the stock market to one of those old newspaper beauty contests, where you don't win by picking the face you think is the prettiest. No, you win by picking the face that you think other people are going to pick as the prettiest. All of a sudden, the game isn't about figuring out what something is actually worth. It's about guessing what the crowd is going to do next.
And that is the engine that drives a bubble. The logic becomes, okay, I know this tulip bulb, or this dot-com stock, is ridiculously overpriced, but I'm going to buy it anyway because I'm pretty sure I can find a greater fool to sell it to for an even higher price before it all comes crashing down. It's just a big game of musical chairs, but with devastating consequences.
So, if everyone's just looking for a greater fool, where are the experts in all of this? The professionals, the market gurus you see on TV, surely they can protect us from this, right? Well, a lot of the time, they're the ones leading the charge.
Take the famous Beardstown ladies.
They were this group of grandmothers from Illinois who became huge media stars in the 90s. They claimed they were getting an incredible annual return of almost 24%, just crushing the market. Their books sold millions. But then, an audit revealed the truth. Their actual return was just over 9%, and they had actually underperformed the market. Turns out, they've been counting their own membership dues as profits. So yeah, the experts aren't always what they seem.
So ultimately, this search for who's to blame for all these bubbles, well, it leads us to a pretty surprising place: the mirror. The most powerful force driving these manias is our own psychology.
As the famous cartoon character Pogo once said, "We have met the enemy, and it is us." And when it comes to investing, our own instincts are very often our own worst enemies.
And behavioral finance shows us exactly why. First, we suffer from overconfidence. We all think we're the smart one who's going to get out right at the top. We're also wired for herd behavior. There's just a primal comfort in running with the crowd, even if that crowd is heading straight for a cliff. And finally, our emotions of pride and regret make us terrible decision makers. We refuse to sell our losing stocks because that would mean admitting we were wrong. But we rush to sell our winners just to feel that little thrill of victory, and that often means cutting our best investment short.
So what's the solution to all this? Well, the core argument of A Random Walk Down Wall Street is actually surprisingly simple. Instead of trying to outsmart the madness, to perfectly time the bubble and find the greater fool, most of us would be far, far better off just owning the entire market through a low-cost index fund and just holding on for the long term.
You know, there's a classic saying in poker that just perfectly sums up the risk of playing the speculation game. It goes like this: if you sit down at the table and you look around, but you can't spot the sucker,
get up and leave, because it's you. And that's the kind of brutal honesty you have to survive in markets that are being driven by emotion. You've got to know what game you're actually playing.
And that brings us to the final, critical question you should really ask yourself. When you invest, are you playing with a strategy, or are you just hoping to find a greater fool before the music stops? Thanks for tuning in.